Hello, Tom Levecki here with a special edition of the New Theory Podcast. We're very close to 100,000 subs. We're at 99,200-ish at the time of this filming. And by the time this goes live, the channel will be close to, if not at 100,000. So please subscribe, please like, and please share with your audience. We've got a very special guest today, Travis David. He's a mortgage advisor with CMG Home Loans. Travis David, welcome to the New Theory Podcast. How you doing today?
Doing awesome, Tom. Thanks for having me.
All right, I'm excited because I know Travis got like about 30-something years, and I call him probably weekly. Can I afford a mortgage? Can I afford a refi? I have a lot of questions, so let's get into it. But first, let's understand, Travis. I know your background. So what initially got you in like the mortgage industry, and how did you get into work with CMG Home Loans?
I actually got into the industry. I go way back when to responding to a classified ad, believe it or not. So I was right out of college. I started in with Daytech Online, then spent some time at Morgan Stanley as a financial advisor. Then I was looking for a little bit of a career change. I remember specifically sitting at my desk. I see a classified ad in the paper, dollar signs 100K plus. I'm like, oh, interesting. I see mortgage sales. And at that point, I'm like, who sells a mortgage? You go to a bank to get a mortgage. I was still young at the time. And I responded to the ad and ended up connecting with my first mentor in the business. And kind of, as they say, the rest is history from there. So
that's awesome. And we're not going to knock banks, but maybe a little bit. But working with a mortgage advisor like yourself, I think I did 2 or 3 mortgages with you over the years. To me, there kind of appears to be an advantage. Give me one of the advantages of working with a mortgage advisor like yourself versus maybe a traditional bank.
Yeah, no, great question. So at the banks, they're good at what they do, but their box is going to be very vanilla type of loan products. When you go to an independent mortgage banker, somebody like myself, you're getting someone with more expertise and who I really refer to myself as a strategic mortgage advisor. We're able to utilize creativity, and as far as loan products go, we have a much bigger suite and different avenues to address particular loan products for a client. At the banks love your typical A paper. We're pretty much you come to us, we're going to do a good evaluation as far as what's going to be the best financing plan for you, and we have the products to deliver on it. So
I like that because one of the reasons why I went with you in the past is I remember at one time, and I think you were transparent, like, hey, check out the bank you're working with. Hey, listen, they'll give you a better deal. Go with them. If not, go with me. And I felt like one of the advantages you didn't just work with one lender. So me as a self-employed guy, I'm a challenge to get a loan for, as you know. How has a mortgage space changed over the years since you first started, and how is it kind of, trending now?
It's trend-wise, we've kind of gone through a few waves. Back when I got into the mortgage business in 2002, we had that refi boom right then, which was great, and then we come into the crisis in 06, 07, 08, and super following that, obviously banks tightened up heavily. So even people who really should be getting credit were not getting money. Then we kind of swung the other way a little bit and, started to open up again. Right now, as far as the mortgage market, and I tell people this all the time, it's a healthy credit market. The people who should be getting the money are getting the money. You may have to go to different sources to find it, but the money is there for the right people who should be borrowing. So
I got a phone call proactively from my bank, and I have a line of credit with them for my business. And it's a little different, but it's kind of related. And they were like voluntarily like, hey, we'd like to give you like 2.5x on the money we're giving you now. Obviously, you got to pay closing fee and all that kind of stuff. But I felt like, again, I went like a few times and they're really kind of trying to throw a little money at me. Not like 407, like that was crazy.
Right.
But it looks like things are thawing out a little bit and the credit market seems to be like opening up. What are your thoughts on that? Is there any like data behind this, or what are your thoughts on that?
Yeah, definitely. So what you have and what a lot of our audience right now really has and is enjoying the fruits of is a lot of homeowners have a lot of equity, right? Home values have been strong over the past 4 or 5 years, probably 50% appreciation over that time period. So home equity is at an all-time high. But so banks in turn, that's an opportunity to lend. So that's why you see we get a lot of requests for home equity lines of credit, home equity loans. The other force on the other end of that equation, though, is credit card debt is at an all-time high. So you now have, people really starting to feel that inflation kind of things are tight. Where they're going to go first is their home equity. And so debt consolidations, even people looking to do improvements, they're leveraging that equity that's there. So that's the biggest, every week it's multiple calls. How do I utilize my equity? Whether it's to consolidate debt, home repairs is just pretty common too. So.
Okay, so let's use a use case for New Jersey. And I know this is a national podcast, but in New Jersey, the market went haywire since COVID. So if I bought a house, let's say for $500,000 right, in 2020 or 2019, right before COVID, pandemic, I don't want to get demonetized. And then in New Jersey, it went up, let's say 50% to 750.
Sure.
Right.
Yeah.
Say I put 100 down, and now I go up 250. My equity is 350. Right. I could borrow what? Basically 80% of that amount.
Pretty much 80% of the current value of the house. So if you're now at 750 value, take 80% of that. That's the max that you can borrow between your first mortgage.
Oh, got it. So they'll minus out.
Right.
And
they'll leverage most banks right now, there are some that'll go to 85, but for the most part, you can leverage up to about 80% of the current value of the house. Now,
and that would be a refinance or home equity loan, or give us actually the difference. Give me what's a refinance exactly, and what is a home equity loan exactly?
Yeah. So a common conversation that we have now is really, do I take out an equity line as essentially a second mortgage, as essentially another credit facility?
No.
In turn, that would keep in place your first mortgage. So if you bought a house and you have that, like many do, that 3% interest rate, a lot of people don't want to part with that.
Correct.
So the strategy there is, hey, if you owe, $400,000 and the property is worth $750,000, well, if it makes sense to do a refinance, we can do that. But why don't we just, explore an equity line as a second mortgage? Equity lines, very low closing costs, interest only for the first 10 years. It is variable interest. So there's different elements to it.
Yeah.
But it is a really good, flexible credit line to have, because you can use it for whatever you need.
And now let's just say, and again, that makes sense, right? If I'm locked in at 3%, I don't want to disturb that. If anything, I need money, let me get it on the second with the appreciation of the house. But what about, is generally a difference in interest rate if I do a refi or a line of credit?
Very much so. Yeah. So you're going to have, if you have an existing first mortgage lien, and you're looking to refinance for cash out per se, to get extra cash.
Yeah.
Cash out refinances are going to carry a rate premium to them. So you'll probably be paying, probably about 0.5% higher than whatever the going interest rate is to do a cash out refinance. So say in that same example, you owe $400,000, you want to get $100,000 out. We would essentially provide you with a new loan at $500,000 and at new rates, but you're going to start at the amortization schedule again too. So there's amortization costs there.
Yeah.
The HELOC is a totally different kind of vehicle, because it's essentially a 10-year draw period. So you can draw on the credit line for 10 years. During that time, you only have to make interest-only payments. So that a lot of people enjoy that, because it's simple interest. It's not amortized like a traditional loan.
Correct.
Once year 11 comes around, that's when it's whatever the balance is, that then amortizes over the next typically 15 to 20 years
additional
as a payback for your payback period.
Okay, then for a HELOC or a line of credit, it's true. Let's say I have a $200,000 line of credit. You don't have to take it all out. You just take what you need, and that's all what you pay interest on, correct?
Yeah, exactly. So that could be something where a lot of people like the idea where they don't have to, they're only paying interest on what they're borrowing, especially if it's if it's something where they're doing a renovation, they're not incurring, they could kind of pay over time and not have to worry about incurring interest on money that's just sitting there.
Now, talk about the current market. So things are fluctuating pretty crazily. We had like a low run, 2-3%, 2.5%, 3.5%, 4%. That's long gone. People have to kind of get over that, if you will.
Sure.
And now in a new environment, 7.5%, it ballooned, I think, up to 8 at one point. So with fluctuating rates, what do you do? What advice do you have for potential home buyers today?
Great question, and that is a loaded question. So, the time that somebody plans on being in a house plays a huge part as far as the cost of financing, and it's going to dictate strategy and loan strategy in a big way. So, the current forecast as far as interest rates go right now, for the remainder of this year, all the consensus pretty much is we're going to remain somewhere in the sixes. There's not going to be any huge. But, and we're right now in March or coming up on April 2025.
Yeah.
For the remainder of the year, we're pretty much going to be in the sixes.
Okay.
That could be 6.2, 6.5, 6.8. So going forward, though, that's where we start to see at least some forecasting that rates are going to start to come down. By the end of 2026, things are expected to start to make their way into the fives. Okay. So if you're a buyer now, what you're looking at is, number one, being in the game is important. Real estate is the biggest driver of net worth for anyone, really. If you look at the biggest separator of net worth in our country, it's people who own real estate and people who don't. So finding a way, just getting in the game, number one, respective of where the interest rate market is going, but you always want to make sure, obviously, what that monthly payment's going to be coming out to be, and making sure that you can at least afford it now, knowing that potentially there may be an opportunity to lower that down the road.
Well, what I'm gathering too is you're saying, hey, you know what? It's in the sixes. It'll go down to fives. But also, if you wait because of the rates, the house can appreciate. So net, you might want to be spending more. So what I'm gathering is don't necessarily let interest rates drive your decision.
100%. Yeah. And that's a great point there, because there are it's not just about interest rate, and just the scenario that you laid out. If you look at that $500,000 house, a 3 to 4% appreciation, that's 20 grand right there. It takes a big interest move to make up that money. So while interest rate is important and a factor, and we're looking at it, there's other forces at play, which, you talk to those people back in 2020 who thought things were expensive and wanted to wait.
Correct.
That's a bit expensive wait.
They paid a big
price for waiting there. Yeah.
Especially in the Jersey market. What are some common misconceptions that people have about mortgages in today's market?
Good question. As far as misconceptions, we always get even after all these years, we still have people think that they need 20% for a down payment. It's, just so everybody knows, you can put down as little as 3%. If for conventional loans, VA loans actually have zero money down. So there's options out there for home buyers to get into homes with very little out of pocket.
And then under 20% or under, you need what, PMI?
Most cases you'll need PMI, which is private mortgage insurance. Okay. And basically that's a cost of insurance that the lender requires you to pay for in case you default.
Got it. So what are some of the biggest challenges that people are facing now to secure a mortgage in today's environment?
One of the biggest challenges now that we pretty much have conversations on an ongoing basis with surround affordability.
Okay.
Again, going back to inflation, just the overall market, high debt that families are carrying. When they're looking to purchase and when looking at their mortgage, they're asking, where can I save and how can I save?
Yeah.
And that's really where it kind of comes down to speaking with somebody like myself to say, hey, let's really dive in. Let's look at what are you carrying as far as debt? Can we reallocate or use part of your equity to lower your monthly debt load? Because it's all about cash flow. So people coming in when we do our initial pre-purchase consultations, which is kind of just an initial size up and kind of our goals and dreams call. It's like, hey, where do you want to be monthly? Can we get there? And if we can't, what do we have to cut out and maybe sacrifice to get there?
That makes sense. What are some of the things? So I'm watching, right? Julian's watching this. He's looking at us, right? Hopefully he's learning a little bit. He's smart and knows stuff anyway. Let's say Julian is looking to buy a house with his lovely wife and his new beautiful daughter, right? And what are some of the things that can he prep prior to calling you? Hey, maybe pay down some of the credit card debt. Is it, maybe not have a long-term lease? Like, I don't know. I'm just thinking out loud.
Yeah.
What are maybe 2 to 3 tips you can give a Julian or somebody out there looking to buy a home? What are some of the tips you can offer?
Yeah. So really, the three biggest things that you can do to prepare is, number one, take a look at your credit. Just go on to freecreditreport.com, grab your credit report, see what the scores are there. just know that whatever that you see as far as the credit report on freecreditreport.com, Credit Karma, those are consumer scores. They are going to be different than when the mortgage company runs them, but it is going to give you at least a good idea of where you're at. Make sure all the information that you're seeing on there is correct. Number two is try to allocate all your funds for closing into one account. One of the biggest drivers of the mortgage process as far as documentation is when people move money around, because we have to source every movement of money that's of any significance. I think we kind of went through that too. So it's really a matter of, in a perfect world, when you're applying for your loan or pre-approval, if you have the money for your down payment and closing costs just sitting in a nice clean account there, you're going to save yourself a lot of headaches.
Smart.
Those are two huge things.
All right. And then, so what are some, like, you mentioned there's different programs. What are some innovative mortgage products that you could speak to at CMG? Like you said, you mentioned VA, I think FHA, there's other types of programs. And also, what programs are there, if you didn't mention any? Number two, are you more of a 15-year guy, let me pay more per month, or a 30-year guy when you make extra money towards the principal?
Loaded question here. So I'll take one. I'll take one at a time here. So as far as loan products go, probably the biggest movement and the biggest shift in the mortgage world recently has been the emergence of what's called non-QM loans, which is non-qualified mortgage. So it's basically the areas which we've kind of discussed in the past, specifically for which very much benefits self-employed borrowers, where we can actually secure loans instead of looking at tax returns, pay stubs. We could basically look at last 12 months or 24 months of bank statements.
Oh, wow. Okay.
And we essentially take a factor of deposits into the business bank statements. There's also asset depletion loans, which are kind of like for if you have maybe an elderly person who just gets Social Security, maybe some small income. But they're asset heavy. Yeah. We can use those assets and generate a income factor for that and help them qualify for a loan. So it all goes back to what I mentioned before. The people who should be getting the money can, because back in the day, that person who can buy the house cash 3 times over, they weren't getting a loan because they didn't show the income. That doesn't make sense.
Correct.
Right?
Correct.
So things have really gotten into a healthy point that way. And I would say the third part is in the investment space. There's the emergence of debt service loans now, which basically, again, instead of using tax returns, pay stubs, all we look at is the rental cash flow on the property. As long as that is sufficient to meet the needs of the mortgage payment, that's how it's used to qualify. So that's a very, very commonly used loan now in the investment space.
Interesting. And what's the difference between a fixed rate and adjustable rate ARM mortgage? And what are the benefits and disadvantages of each?
Yeah, so fixed rate loan is going to be just that for the entire term of the loan, whether it's a 10-year fixed, 15, 20. The interest rate that you secure at closing is going to be the rate for the remainder of the loan. You also mentioned before, as far as just my personal opinion, as far as 15-year, 20-year, it is a very personal decision. However, I'm much more so find myself advising clients to take the 30-year term or take a little bit longer than they may expect, because it gives them they don't have the obligation of making that lower payment, but they still have the option to. And it helps people maintain control. If somebody does, if they get jammed up or come on hard times, you don't have that obligated higher payment monthly, kind of gives you a fallback. But again, we can still do a calculation to say, if you take out a 30-year loan, here's what you need to pay each month to have it paid off in 15 years. Yeah. We call that the freedom point. And that's a common part of our analysis as far as when we dive into things too.
What are some of the often overlooked costs associated with buying a home beyond the down payment?
Commonly overlooked, I would say, one of the things when people are considering down payment and closing costs, they have a number in their head as far as, okay, I'm good allocating X amount. What's commonly is not thought about, I would say, are furnishings, repairs, and moving expenses they're going to immediately incur afterwards. Yeah. A lot of people actually don't. Some consider, but most people don't. And then on refinances, you have what's called the amortization cost. So if somebody they've had a 30-year loan, but they've had it for 7 or 8 years, they've paid 7 or 8 years of interest in it. If they go refinance to another 30-year loan, yeah, your payment's lower, but you now just you're now incurring more interest because of the amortization cost that you're now going to incur. So that's a kind of a hidden cost there that a lot of people don't think about.
Despite the high rates, especially in New Jersey, and by the way, Travis works out of New Jersey, New York, Pennsylvania, and Florida. So if you need a mortgage or refi or loan, his link will be below. He's happy to refer to you if you're not in those areas. But despite the high interest rate, the market's still hot. And looking for a house, I know in New Jersey, like I saw like a $500,000 house go for $100,000 over market.
Sure.
So when you engage, let's say, a real estate agent or real estate broker, pre-approvals are important. So can you walk through, why you need a pre-approval and what's the importance of getting one?
Yeah, pre-approval it's kind of like your insurance policy when you're buying a house. It doesn't cost you anything, but provides a huge value in the fact that the main point of it is to make sure that you have a good understanding of your budget and what your max buying power is going to be. What I always tell people is if you're not getting pre-approved, it's like going shopping on a shopping spree and not knowing how much is on the card.
True.
Right? That's never a winning strategy. But what it's also going to do is it's going to let the market know that you're a serious buyer. If you find that house that you want to make a move on, number one, your realtor is going to require it from you right away because they needed to submit the offer.
Yeah.
And then if it's a solid pre-approval, it is going to carry some weight in the market. And I like to think reputable lenders that do have a good name on the street, when a listing agent sees a pre-approval come from that person or that lender, it does actually impact, hey, do I go with this offer with, online lender X, or do I go with the local lender who I know can close and provides it, has some confidence behind it?
Yeah, because but pre-approvals aren't a layup, meaning you get your pre-approval and it's like, hey, you're good for this X amount, but it's not necessarily the case, correct?
Pre-approval is probably one of the more subjective words in our industry because it can be used very, very loosely. Some people will say, hey, you're pre-approved just by a conversation and a credit pull. That really doesn't do anybody any help because in the mortgage world, documentation is what tells the story. And if your pay stubs aren't, tax returns, if they're not being evaluated, it's not really a pre-approval.
Yeah.
There's basically 3 levels of approval. There's a pre-qualification, which is, again, basically that just, hey, conversation and credit pull, you're pre-qualified based on this for that. But when you actually take the next step to getting pre-approved, it is a thorough evaluation of credit, all your documentation, and also the loan is being submitted through automated underwriting to get that actual approval.
Yeah.
And then there's even one step beyond that, which is a pre-underwrite, where we get everything, we actually submit it to underwriting and get the stamp of approval. Yeah. So there's pretty much 3 levels of a pre-approval per se.
The other thing is, I noticed like over the years, obviously use you for different loan and loan vehicles, but it seems like you have a lot more resources now. There's calculators. I know you do like that Loom or whatever. You'll send a video follow, which I think is pretty cool. It saves an email or a meeting. What are some of the resources and support that CMG Home Loans and you provide to basically your clients that may use you?
Yeah, so that's changed a lot as well in just honestly in a number of industries, but how we deliver information and advice.
Yeah.
We're in a world that's changing quickly technologically. So I've included now, and just as part of my process is, we have a great platform which is called Mortgage Coach. It's an awesome platform where it allows me to show visually side by side different loan programs, different loan scenarios. It's really where we're able to not just talk about numbers, we actually look at them and make sure, hey, this is option A is right because, right? It's not just not just looking at simple things. We're talking about time to pay off the loan, if there's any fees involved with different loan programs. But just going back to technology, we utilize video a fair amount as well.
Yeah, that's cool.
And just kind of delivering certain updates and communicating things in not just a verbal way, but visual, because numbers get convoluted over the phone.
Well, you've also been, and we'll get into kind of a little bit about the job itself, but I do want to kind of sidebar a little bit. You've always been pretty progressive on doing different types of marketing initiatives, building relationships. You're doing some podcasting now. I don't see it. I mean, I see some in the mortgage space do like a lot of the bigger, kind of advisors. Yeah. Why aren't advisors doing more? Like real estate adopted that, right? Like you can't swing a dead cat without having the realtor who sells in New Jersey, blah, blah. But in the mortgage space, although it's common in marketing, you're a little bit of a pioneer by doing this stuff. Why do you think mortgage advisors have not adopted maybe the same strategy as real estate agents, in your opinion?
In all honesty, I think a lot of real estate agents and lenders are still behind the eight ball there, because it's the emergence of, we all know social is there. That's how people are doing business more often. Part of the reason why I'm doing this, obviously, expand my personal brand, and the players in real estate and in the mortgage space who are progressive and kind of taking that forward look. You're going to have to expand your brand. You're going to have to be visible to more people and explain or really showcase why people should work with you. Yeah. And it's not just the days of, hey, I need a loan, let me just call up, get a quote. Those are far gone. Correct. The level and honestly the expectation of a lending partner right now, I think, is at an all-time high. Whereas you have to be delivering more. And part of my practice is I love, as a financial advisor background, I love talking about net worth. I love talking about building and scaling a real estate portfolio. Yeah. How do we maximize equity? How do we, save on as far as monthly payments and monthly debt load? Those are the kind of fun conversations for me. Nice.
I like that. And then what are some common mistakes home buyers make when choosing a mortgage lender?
I mean, the biggest one, really, it's pretty straightforward, is choosing a lender just based on interest rate. Yeah. We still get it because it is it's a way to kind of simplify the whole process, is this rate versus this rate. But it obviously comes well short as far as telling the whole story. Correct. Unless you're comparing literally on a specific day, loan program side by side, looking at the fees behind the interest rate. That's one of the most important things. That's the biggest kind of miss that people make as far as shopping for lender just on interest rate. So,
how do you guide clients through the often complex mortgage application process?
The mortgage process really now it's kind of gotten pretty streamlined in a good way. Where when we get first introduced to a client, I have that goals and dreams kind of discovery call with them, find out what's important to them, why they're looking to buy a house, get a sense of their situation. Following that, they're completing what we call our online questionnaire, which is basically just some general information. And we're also collecting documents at that point. And we're doing our initial review and size up of, hey, where do you stand as far as credit? How do things look as far as from a debt and income perspective? And what are you working with as far as capital? Because a mortgage approval basically is kind of like a triangle. Correct. With credit at one point, income and debts on the other, and then your cash on hand on the third. That's kind of the guts and foundation of a mortgage approval.
You saved my ass one year when I needed, I'm maniacal about my credit score, and during the pandemic and other things, I think I went to one of the furniture outlets, got the new house. They zero interest for a year. Yeah. So when I'm old school, I like the print statements. So when I got the furniture, I said zero for a year. I wasn't getting the print statements, but I'm like, oh, it's zero interest, not a big deal. But there still was minimum payments. So I literally had one late payment on that. And then I remember when the pandemic hit, on a lease that I had, they're like, oh, you can defer. It was weird. You can defer your payments, right? Remember, amnesty or whatever. But all it did was it just deferred from here to here. You still paid interest, you still paid whatever. Sure. And one was still done. I missed that. So my credit score went from 800 to 600, and I was freaking out. And you had me, and you recommended somebody, which was great. But my point being is, what are some credit repair or credit kind of strategies can you give today?
Yeah, probably the most just a good rule of thumb is to keep your revolving balances, which are basically your credit cards, less than about 30% of the balance.
Of the balance, okay.
Once you get beyond 30%, you're really going to start losing points for utilization. It's good to have a good mix of credit, meaning that if you can have credit cards, which is considered revolving, if you have a student loan or car payment, which is installment, and then you add on a mortgage on there, that just shows a good a good manager of different kinds of credit, and the credit models like that. But what I also would say is if you try to bring logic to credit, you're probably going to spin yourself in circles, because a lot of the credit models there's nuance to them that doesn't necessarily make sense. So that's why if you're not seeing 780 or 790 above on your scores, what I always recommend people do, talk with us first, let us evaluate the credit, and we'll give you the action plan as far as what to do, because we're going to know better than you as far as what's going to impact the score.
So we're going to say generically speaking, we're not going to like kind of lock it in, because I don't want to give people wrong advice.
Sure.
But the whole DTI, what is that, debt to income ratio? So let's just say I'm making $100,000 a year. I'm making roughly let's say $9,000 a month with every 108. So let's say $8,000 a month. Say 96, $8,000 a month. Roughly, how much mortgage do I should be able to afford?
Well, as far as
in New Jersey,
right? Yeah. So the debt to income ratios, there's two of them. One of them is the housing ratio, which basically takes the mortgage payment that you would have, and as a ratio of your monthly gross income. Okay. So if you're grossing $8,000 a month as far as your qualifying income, I mean, technically, a lot of loan programs, we can go up to about 40 to 45% of that number.
Oh, wow.
A good rule of thumb, though, is probably more around 30 to 35.
So you don't get yourself stuck with like too much of a burden. So you got to eat, expenses. Okay.
And then there's behind that, there's the overall debt ratio, which not only takes into account the housing payment, but also adds up all your other debt, the minimum payments there. And that has to be generally less than 50%. So it's 30%.
Okay, got it. So you have 30% for, let's say, $2,400 mortgage. Is that all in, or is that including tax and everything else?
No, that's all in with principal, interest, taxes, and insurance. I would say probably about 38.
$2,400 mortgage in New Jersey is low.
Yeah, it's not very rarely, unless somebody really has strong income. I'm not seeing too many 30, 35 front end ratios anymore. Everybody's, because we're in an environment where everybody's pushing. They're having to pay more for homes. They're still carrying more debt. Yeah. Interest rates are a little bit more elevated where they're at. So what do I honestly see on a daily basis on front end ratios? It's 40, 42. Like that's where it's at.
Wow.
So
here comes another bubble.
Yeah, that's why we have to be just conscious of, hey, how much are we spending? What does that cash flow look like? Are we, the key metric that I always tell people too is, when you buy this house, are you still going to be able to save money?
Yeah.
Right? That's such a huge factor. Whereas let's look at your household like a business. Are we making money and having positive cash flow on a monthly basis? Because if not, you're going to find yourself behind the eight ball pretty quick.
Is there different vehicles and profiles? So for example, let's just say, standard bank, standard lender, a paper, like you would say, is 30%, and it's going to be, 6.0 interest, but you could push it to 40, but it's a high risk lender and they're going to charge you 6.5. Does that happen or not really?
Not so much. Okay. It's part of the pre-approval process, and I can't obviously speak to other lenders, but part of our process is identifying what those thresholds are, right? Yeah. And my very first conversation is going to be, what's the monthly payment where you would say, if it's there, I'm going to either start losing sleep at night, or I'm just not going to be able to do it. I want to identify that. Yeah. Never mind what the approval is. Yeah. I want to know, because there's things I don't see on the credit report either. If somebody has a big daycare expense, I'm not seeing that.
Yeah.
So, and it could be, daycare right now could be another mortgage payment. So
$2,800 for 2 kids under 5.
Yeah, that's what I'm saying. Now, I wouldn't see that.
That's cheap too.
So it's all part of that exploratory process of saying, where's your comfort level? Let's establish the boundaries and try to stay under that. So.
Okay. So the other thing is, and then I want to get into a little bit about like the career itself, because I find it interesting. What about like in terms of debt, right? So when I look, I say credit card debt is in that DTI, right? What's in that DTI?
It's going to be the minimum payments on each of the loans that you're carrying.
Credit card,
car payments, student loans, other mortgages and other real estate. There's a little bit more involved calculation, but that factors in as well. It's pretty much everything in the mortgage world on approvals is kind of boiled down to a monthly calculation.
Got it. All right. So knowing Travis for a number of years, you're an entrepreneur. I don't think you can work a 9 to 5. I don't think you ever did really.
I did, and it wasn't for me. We'll leave it at that.
Yeah. So that's what I respect about you. So what advice do you have for like self-employed individuals looking to, for like yourself? First, we'll talk about for self-employed people like myself and you.
Yeah.
How do they, them getting a loan or us getting a loan is different than a 9 to 5 person, who works at Merck or whatever. What kind of advice do you have to self-employed people?
The biggest thing or probably most important thing as a self-employed borrower, or if you're looking to purchase a home, is going to be connecting with somebody like myself, a lending partner, as early on as possible.
Yes.
Because the way that mortgage approvals work for self-employed borrowers, for conventional loans, we have to look back 2 years for tax returns.
Ooh.
And utilize it. There's a calculation based on that.
Yeah.
So what you file, even if you're looking to buy in 2026 or 27, what you file now is actually going to impact how much you can borrow then. So we do a big part of how we service our self-employed borrowers is, hey, let's get an idea. Let's get a snapshot of where you're at now. What kind of buying power do you need? And we'll reverse engineer. Okay, if you want to be there, this is what you actually need to show per se, or at least have as far as net income for your business on the tax returns. Because for W-2 employees, we're able to use the gross, but for self-employed, it's very different.
Yeah.
We're showing net. We have to use net numbers. So that's after all your write-offs and everything. So you don't get the best of both worlds, which I know you know.
Yes. Well, that's okay. So one of the things I struggle with, and I'm going to make it very clear that we believe in tax avoidance is okay, meaning you could appropriately manage your tax structure.
Yes.
I'm sure I said this correctly. And tax evasion is wrong, kids. Okay. Tax evasion is wrong. But with that said, though, is you do have some discretion in terms of, what you report, where, add backs and appropriate and all that kind of stuff. I don't want to get into tax and legal advice, but what I'm getting at is if you are reporting as self-employed and you were maybe, we don't say underreport, but maybe you're maximizing tax advantages and reporting a lower income, they're going to get you on the mortgage. So some years it might make sense to maybe pay more in taxes, even if you don't need to secure a better loan.
This becomes a very, very strategic exercise because the ramifications are huge. And I know just kind of our conversations, it could be 30, 40, 50,000 difference in a tax bill, depending on how you play it.
Yeah.
So that's why we're going to look at, hey, what are we coming out to as far as net income on your business?
Yeah. Does
it make sense to continue to try to utilize that? Or like I mentioned before, do we pivot to a bank statement program where you don't have to worry about your tax returns as long as we, show enough in deposits, we can qualify that way, and you don't have to worry about an increased tax bill or however much you have to change your tax reporting.
Bring some notes. A difference in interest rates between a bank statement and a conventional, probably a little bit, right?
A little bit. It's actually, that margin has actually come in a lot. It typically,
really?
The bank statement programs were probably about 2 percentage points higher than a regular conventional loan. That margin has come down considerably. Now it's probably anywhere between probably about 3/4 to maybe 1.5, depending on the credit situation. It is. It makes it that much more affordable by going bank statement.
So somebody looking to refi, I know we kind of touched on refi, but I do want to talk about it a little bit. When someone wants to refi an existing mortgage, take advantage of a lower interest rate or even better terms, what is a rule of thumb? I know this would be generic, but what is a rule of thumb? Is it a point less, 2 points less? I know how long you're staying there, but what's a rule of thumb of when you should refi?
If we're talking about refinancing just to lower interest rate
and payments, yeah.
If the loan amount is going to be probably less than 500,000, a 1% reduction is fair.
Okay.
If the loan amount is higher than 500, you could probably start entertaining things probably around 0.6 to 0.7 less.
Okay.
Because it's just on a higher loan amount, so the savings will be there. One of the great things as far as when you purchase a home through us at CMG, you get credits for items that you don't have to pay for on the refinance. So we make it very,
Oh, wow.
very affordable to refinance your loan after you've done your purchase.
Interesting.
And, on any refinance where we're lowering interest rate, there's going to be title cost. You'll have recording fee, a couple $1,000s in cost there that can be rolled into the loan. But we're doing a break-even analysis on that to say,
To see when it's worth it.
Right. If we're putting up, $2,500 to save, $300 a month, that's a pretty fast payback period.
Get back in 8 months.
Right. Exactly. That would be a win. So
I like that. All right. And then what are some of the strategies for those who have a low down payment? You did mention there are some programs for those people that just, I have 8%, 10%. Like, what are some strategies there?
Yeah, there's the most common program that we use or that's available to clients is NJHMFA, which is the down payment assistance program. That how much they give you is based on the county you're in. Most counties it's $15,000. A lot of the southern counties it's $10,000 towards down payment and closing costs. There's also a kicker to that, which provides an extra $7,000 if you're a first generation home buyer, meaning that if your parents do not own a house or have not in the past 3 years.
And what's that called?
NJHMFA, New Jersey Housing and Mortgage Finance Authority. And they're it's a state sponsored program.
Yeah. It's cool.
But it provides, we do a lot of loans through NJHMFA because it does have flexible guidelines as far as qualifying.
Yeah.
There's conventional and FHA products through it, but it's just a good vehicle to use to get that person who doesn't have the resources to immediately put them in a position where they have the money for down payment and closing costs. And
interesting.
Just going back to getting in the game is key, and getting together that down payment is still one of the biggest barriers of home ownership, and that helps with that.
I have to bring up the self-employment again because that's like my area, and I like get some free advice from Trav. There's some things that are good and bad, or included or not included. When you have a high T&E, like restaurants and that kind of stuff for either entertaining or employee meals, that gets taken out of the equation, correct?
It does.
Oh, that's a question.
Yeah, and I know. Yeah, so those of you who are self-employed,
like $25,000.
Yeah, who entertain and have that line item there for travel, meals and travel expenses, that does get deducted further from the calculation. So,
ouch.
There's literally a worksheet, which is pretty much a spreadsheet that's used to calculate that, and that's one of the biggest. That could really come back to bite you.
But one advantage was, again, we're not giving tax advice, but I do have a self-employment IRA, and I was happy to know that was not taken out, I think, right? The SEPs?
The SEPs, well, the calculation really doesn't, whatever you're filing on your Schedule C, or if it's
whatever it is, right?
Yeah, we're basically going off of those line items.
That's awesome.
So it's not you can, and again, you should be contributing to those because it still provides a tax benefit.
Correct.
But that's not factoring into our calculation on the worksheet.
What about if you have, not a lot of money and you need a down payment? Like, do you recommend hitting a 401k IRA? I know there's like penalties if you're under X amount of age. Is that something you've seen in the past, and do you encourage or discourage that?
Probably one of the best and underutilized areas for down payment and closing costs is a 401k that people are actively contributing to, and not taking it as a distribution, but taking it as a loan.
Oh wow, you can, right?
Right, yeah, and it's just a great vehicle because most administrators, they'll allow you to take up to 50% of the value, up to $50,000. Okay, that's pretty much across the board. But what's great about it is you are being charged interest, but you're paying yourself back the interest.
Correct.
It's essentially a 0% loan, a no-cost loan, and you also get to dictate in most cases the payback terms. You can say, listen, 24 months, 36 months, for the most part, probably up to 5 years. So if you're actively contributing to a 401k, just know you can. If you don't have any loans out against it now, you can borrow from there for your down payment.
Do you know if you do it for an IRA too?
For an IRA, you have to fill out specific forms for distribution to allow it for a home purchase. You can't quote unquote borrow against it once it's moved out of the 401k shell.
Interesting.
So
I thought they were similar. So that's interesting.
Yeah.
I know you've helped me in the past. Can you assist clients with investment property mortgages?
It's a big part of what we do.
Okay.
Most of our clients fall into kind of three buckets. One is first-time home buyers. We love serving first-time home buyers just because they're the people probably who need us the most. So we're able to really provide a super valuable service and guidance, and it starts people on their home ownership journey. So it's always, it's an exciting time. The second segment of our clients are investors / self-employed. That's a big part of what we do. A lot of our clients have started out buying a home with us, but now are looking to buy a multi-unit, kind of scale out a portfolio. We have a lot of investment avenues to take those borrowers and really help them to efficiently buy investment property. So that's second. And then third is renovation. We do a lot of renovation loans. I'm a huge believer in renovation financing. Again, another underutilized asset where, somebody literally can, first-time home buyer, instead of looking for that property that's done already, and in this market, things are tight, it's hard finding something, why not identify a good location and look at a fixer-upper? Because we can finance 96.5% of purchase and renovation amount for somebody. So it's a good way as a wealth building measure as well.
So, you deal with a lot of people, a lot of, entrepreneurs, people W-2, et cetera. So you deal like where you run the gamut. What are some of the most memorable success stories that you had with a client or two?
Memorable success stories. I think it's really, it's my clients who are really utilizing real estate to their fullest. And it kind of goes back to, I can't think of one in particular, but there's more than a handful where they are now sitting on multiple units of real estate because we kind of laid out the pathway for them to say, listen, just buy your first property and let's get that one under your belt. And then they got the fever of realizing the benefits of real estate. And then we help them buy that next property and buy the property after that. Those are probably because those people are benefiting, their net worth has gone up considerably by virtue of owning real estate. So
smart. Now we talked a bit earlier about, this is a true entrepreneurial type job. You love doing it, you're doing it for a while. What type of person should maybe check out being a mortgage advisor?
Good question.
Somebody who's crazy? No, I'm just kidding. I'm just kidding.
Listen, it is a eat what you kill business, right?
Yeah.
We don't get salaries or anything like that. And my best recommendation, if I were probably to do it a different route, is to link up with a seasoned professional, be part of a team up front,
like that,
grab a small salary and kind of learn on the job. I was pretty much thrown into it.
Yeah.
So it was challenging up front. It's you're learning on the job and you're not making much money. But if you have a yearning to truly help people and you enjoy the real estate and you enjoy the creative aspect of finance and providing solutions, that's the most important thing.
Yeah.
So but yeah, you have to have a true passion for it, because if you don't, you're going to find it extremely, extremely difficult.
What are some of your first, kind of professional goals over the next few years for yourself, CMG, and your team?
As far as my personal team, I'm basically looking to expand to get two or three loan officers, or nice. 2 or 3 younger people who are really looking to learn the business, have an appetite for it, want to learn, kind of take them under my wing. I've learned a ton over the past 20 plus years now. And I feel like it's an area where I could provide a good pathway for somebody who wants to learn, who has a hunger for the business and really just wants to get an idea of what this career path looks like, because it could be very, very fruitful when you do it the right way.
If you could give one piece of financial advice to people listening and watching, what would it be?
I would say, no matter, like many things in life, take the time to prepare.
Yeah.
It's what I preach constantly on a weekly basis. Preparing, especially for a home purchase, is going to save you so much time, energy, and stress during the process. And our pre-approval process, it really is that. It's a preparation exercise of making sure that we're clearing the path for all potential issues going forward, dare I say, somebody actually enjoy the mortgage experience,
Nice.
which is not heard of too often. So
I think we covered a lot, but is there a question that I didn't ask you that you wish I did?
a question that you didn't ask me. Not sure.
Okay, fair enough. It means I did a good job, right, Julian?
Not sure.
All right. So we're going to put a link below. We have a landing page that you can go. Again, licensed in New Jersey, New York, Pennsylvania, Florida. Trav is a good guy, known for years. If some reason, if you're not in those areas, but maybe you can give a referral, I think you'd be happy to do so if somebody wants to reach out. But we'll put a link below. But for those that are listening in, how can people find you?
Easiest way is travisdavidlending.com, or you can always call me directly, 732-713-5020. We'll be happy to help you.
Love it, man. It's been a long time coming. Thanks for coming.
No, definitely. Thanks, man.
All right, see you guys next time. Subscribe, like, follow, share. And again, if you need a mortgage, tell them, reach out to Trav. Tell them New Theory sent you.